Hello and a very warm welcome, everyone. I'm your host, Sukhjit Singh, and today we will discuss about some of the key macro events we had. We had some last week, and what some macro events we are having for the upcoming next week. So before we start heading to these macro event week ahead trade analysis, it is really important to think why we do these macro event analysis, because as being the trader, especially forex trader, we need to keep an eye on these macro events we have, because these macro events really lead the way, really make the roadmap how the central bank will behave on these surprises, or let's say beating the expectations from the market forecast is really shape the currencies, giving them a bullish or bearish bias. So with that being said, let's quickly have a look on what we had last week before moving to do some analysis for the next week. Starting from last week, the main event we had was US. From the dollar side, we had a inflation report, and we also had a FOMC event. And from Japan side, we had just one major event. There was the Bank of Japan policy rate decision. We also had some other events. Some of them were from the pound side. We had labor data on Tuesday. We had GDP data on Wednesday, and if we look at the China side, we had a CPI and PPI report coming on Tuesday. And if we look at the Aussie side, we had a labor data on Wednesday, stating 4% unemployment rate and employment change came better than expected. Of course, we will go through all of these data along when we move towards to our next day's analysis. So for the dollar side, we had of course, we had a US inflation and FOMC report, but from the not that major, just other events, we had a University of Michigan preliminary data coming on Friday, and at 11 a.m. which came just a little bit downside from the market expectation with a revision 69.1 from 67.4. Okay, so these were the all key events we had last week. However, before beginning, let's go through some of the main events we had. First one was from the dollar side, we had a CPI report, which really surprised the market by just coming 0.2% from the last report, which was showing core CPI 0.3% and CPI month of month 0.3%, coming way worse than expected. Market was expecting 0.1%, but we had 0.0%. So the CPI year of year, which shows really good signs of cooling, which was some kind of a bearish for dollar, but good for as a consumer point of view, that the inflation is getting under control. But from Fed point of view, it is not still there. It's still sitting at 3.3%, which is quite stickier than anyone would have anticipated. So the prior report was 3.4%, as it has been shown on this forex factory chart, and the market was expecting same 3.4%, but we had 3.3%. So across the board, across the whole data, we saw really nice downward beat toward the expectations, showing really good signs of cooling from the inflation point of view. So now look at a timely chart where we are sitting right now. So this is a chart of US CPI year of year, and if we start from the 2020, when it really started picking up from going from a zero negative 0.1% to all the way July 2022, where it peaked to 8.9%. So how it all started, I think the main leading event to causing these kind of inflation is just because when when the Fed, or not just we can say the Fed, when the government start giving a free stimulus checks to the people, and what they do is it really creates the bubble where the stocks goes up, and the value of the cash start bleeding, because of there is so much cash going on in the economy, and which eventually lead to higher inflations, and higher inflation technically, or let's just say purely, leads to the higher interest rates that we saw after these were coming out of June 2022. However, on the June 2022, after those events, the Fed wasn't really kind of keen to increase the interest rate. They were keep saying that it was just a transitory uh, phase, and it will get over eventually, and they hold the interest rate, I think, for some quite some time. And however, after they really seeing the sharp move toward 3%, 4.4%, that was the time when they realized that it's time to increase the interest rate, and they started doing it. If we okay, so here's the thing. Let me just bring in the federal fund cash rate, and let me just go let me just go for a line bar here, and let's see if we pull a parallel 2021. Okay, so 2020, let me just make it a little bigger. There we go. So look at this. Let me just move it down. Okay, so here is the thing. We had inflation coming down with the interest rate staying at 1.6%. Inflation was at that point was 2.5%. After that, we saw COVID-19 came out, and which eventually led to the countries to shut down their businesses across the board, and the government forced the people to stay in their homes and giving them the free checks to survive on that. So from 2.6% to heading to 0.91%, that eventually gave the Fed a reason to lower their interest rate from 1.6% to almost 0%. And look at this, 1.5%, that it took just two meetings to reach from 1.7% to 0.3%. Isn't that amazing? However, they kept that rate for almost March 2020, almost for 2 years. And they weren't still believing that the inflation has is there and it's not transitory. So on 2021, we had 1.1% inflation rate. And uh, in 2021, we were just sitting right at the. Okay, what is going on here? Okay, so where was I? All right, right here. So on March 2021, the inflation was at 1.6%, and if we look at the federal fund rate at 2021, it was just at a 0% almost. It stays till January 2022, and where were we on that point? January 2022, the inflation was at 6.7%, when the the Fed thought that, okay, it is not transitory, and we need to start increasing the interest rate. You see that how long it took them to realize that this inflation is not transitory, and we have to react on it. In order to control it, we have to increase the interest rate, and they really did it very sharply, and within a year, from January 2022 to February 2023, we were at a 4.6% Fed as a Fed funds rate, and when inflation was at the peak 9.3% on July 2022, we were sitting at the top 5.5% inflation. Or my bad, 5.5 federal fund rate. So after that, the Fed kept their rates over there from July 2023 to June 2024. It's been a whole 1 year when they have kept their rates right there where it was at July 2023, and it's been almost 2 years when they have started increasing the interest rate. We will go deep into what is going on the federal on the FOMC side. We also had a report on Wednesday on this. But however, if we look at the focus on the CPI report, it is coming down, but however, as you can see, it's just like got sticky. It's from July 2023, it was at 2.9%, and then it went to 3.6%, and again 3%. If you look at the quarter one 2024, on average, it went down on February, but again it went up at 3.3%. And however, on the quarter two, we do have some cooling signs from the inflation side. It started from 3.4% and leaning toward 3.2% and 3.3%. But we don't know. We don't know how long it's gonna take that sticky inflation to reach at the Fed's level at 2%. It can take some time. However, the currently market is pricing two cuts. However, we had FOMC projection, and we will go through it just after this report, that the Fed is currently pricing in just one cut for this year. So, with that being said, all right, let me just close this time frame. Okay, so with that being said, we had FOMC report on Wednesday, June 12th, and if I'm not wrong, it's just kept their rate at 5.5% as market expected. We had economic projections from FOMC side, and also we had a statement. So let's go through the statement we had. All right, this was the statement they have released on June 12th, 2024, as you can see. So I have marked these some of the key notes where usually I try to focus on, and what they have changed, anything in their tone or in their words which can lean toward a hawkish or dovish statement. So they said they have changed a little bit in this one statement. In recent months, there has been a modest further progress toward the committee's 2% inflation objective. Why they are saying this? Because as I have showed in you, in a quarter in a quarter two, it has shown a moderate further progress from 3.5% to 3.3%. So next key thing was that the committee decided to maintain the target rate for the federal funds rate at quarter to 5.5%. So the next thing, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably 2% target. So that was okay. Let me just go through. The committee does not expect it will be appropriate to reduce. So that was some sort of a hawkish statement stating that committee does not expect it will appropriate to reduce their interest rates until they don't have enough confidence that inflation is at a 2% or sustainably moving toward 2%. And the next keynote I have marked here, the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerged that could impede the attainment of the committee's goal. So what they are trying to say is that if anything happens wrong other than CPI report not coming to 2%, even though if the inflation stays at 3%, and rather than that, if something tragic happens, they will not hesitate to decrease their interest rate according with the situation they're going to have on that time. So overall, the statement was okay, leaning toward a neutral, not that hawkish or not that dovish statement. So the major event was to looking at a summary of economic projections we had, and the key event was to look at this economic projection of Federal Reserve Board members and Federal Reserve Bank presidents. Okay, so here's the thing. It was what they did. They just went hawkish and said, "Hey, we're not gonna decrease the interest rate. How we're gonna keep it there, and maybe we not perform more cuts than the market are already trying to price in." So the market is currently pricing in two cuts for this year. Okay, so the first one happening on September 18th, 2024, with the 19 basis point of worth of cuts, and the second probably coming in December 18th, 2024, with the 49 almost 50 basis point of worth of cut. But how on the Fed point of view, they were hawkish and they said, "Hey, you need to calm your horses. They are running very fast. Okay, we're not gonna cut these rates that at that pace. We may cut. There can be a one cut, but it solely depends on the data." Okay, currently these projections are currently what we are thinking right now. It's not a benchmark. This is what they think. Okay, so currently they are stating for 2024 here from 2024. Okay, okay. So what's going on here? Okay, what just happened? What happened here? Okay, let me just open this up again. I think there's an error on this. What's happened? Okay, so where is it? FMC projections. Let me just close this one up. Oh, okay. Now there we go. Okay, so sorry about that. So the market, what they said, "Hey, listen, you need to calm your horses, and we're not gonna the cut the race as you are expecting. The pace of the rate cut is gonna be very slow, and we may perform one cut this year, but there aren't gonna be two cuts." So with that being said, the federal funds rate is currently projecting at 5.1%, and the interest rate is sitting at 5.5%. So there can be or maybe just one cut for this year, and they increased this projection from 4.6% to 5.5%. That's what it led to a hawkish statement. So they also increased their projections for core PCE for March. This is at 2.6%, now sitting at 2.8% for 2025. They also increased their projection from 2.2 to 2.3 for PC inflation. They increased from 2.4 to 2.6 for March, from 2.2 to 2.3, and for the longer run, they kept their PC inflation projections at 2.2%. However, the main thing the market focused on was the federal fund release. How is it? Did they increase or not for the longer run? And guess what they did? They just increased by 20 basis points, stating that they're going to increase it, but they're going to keep it, not increase it. They're going to keep it there. uh, but higher than the previous the March projections at 2.8%. The March projections was 2.6%. Okay, so now let's look at the dot plots here. So let me just draw a line here. The current interest rate is sitting right here. Okay, 5.5%. So what this dot plot projection is telling us, first of all, what are these dots? These dots are each member sitting in that room voting for whether the interest rate should stay where it is right now or whether it goes down by 25 basis points or 50 basis. It's just dot is just an individual showing their thoughts on where the interest rate should stay. So 1, 2, 3, 4. We have 4 members of FOMC stating that hey, we want no cuts this year. Okay, and there are. Oh, I have wrote those numbers down here. I am reading from there. Just give me a second, guys. Okay, so 7 are expecting 1 cut, and 8 members are stating there can be a 2 cuts. For the longer for the next year 2025, one is saying there's no cut, one C 2 basis points of cut, but majority of the C's are sitting at close 4.25% worth of 3 cuts. For next year 100 basis points of cut, and for 2026 they expect to stay at 3.5%, also 100 basis points of cuts. And for the longer, again, they say that it can stay around what here, 2.5 to 2.8%. So these were the Fed's projections we had, and these projections were really some sort of a hawkish statement, which helped the market to get on the board and buy some dollar and put some money in there so that they can make some returns on it. So this is the FOMC statement we had on this, and as you can see, this market just kept going upwards before we have in the PPI report. So let's move to the presser. Okay, so on a forexlive.com, this is something you should also keep an eye on, because this is where majority of the traders across the world put their insights and thoughts on how they take these pressers, or how they take this in event reports coming out. It's so this is a really helpful site for traders. So at the bottom here say that the Powell Q&A, regardless of dots, everyone at FOMC would say they are very data dependent. So the bold is all that matters, really matters. It's safe to go back to watching data. So there are some key notes he talked about. Just once our sense is that the rate cuts that were going to take place this year will take place next year. This is really a hawkish comment from the Powell, and our plan is not to wait for things to break and then try to fix them. Is a dovish comment. So here you can see this guy knows what he's talking about. He does not want to create that much volatility across the market, so that he tried to stay neutral, some sort of saying, hey, we may can do this thing. However, if we get this thing, we may do that thing. It solely depends on data, and not giving any clue to the markets. So that was the FOMC report we had, and now let's head back to our calendar chart. let me just close this one. And the next key event we are having here is the Bank of Japan policy rate decision. Let me just grab that. Okay, so Bank of Japan policy decision right here. All right. Okay. So on Friday, Bank of Japan came out and kept their rates where they are right now at 0.1%. So this wasn't something that I was looking to trade. However, the sole focus was on that what they're gonna do about their tapering program. They were talking about a week ago on Nikkei. We had a report stating that the Bank of Japan may introduce their tapering at this week, with stating that they might reduce their Bank of JGB holdings. But however, they just did opposite to that. What they did, here it is. The bank decided by an 8 by 1 majority vote that it would reduce its purchase amount of JGB. Okay, that's something we want to hear. Thereafter, to ensure that long-term interest rate would be formed more freely in financial markets. Now, here comes the tricky part. It will collect views from market participants and at the next monetary policy meeting. So they are not doing it right now. They are doing it at the next meeting. This is what where the market really got surprised and sold the yen. Okay, so they really sold the yen. And if I go again to here, so I already took the trade before the Bank of Japan rate season or season, as they are already, as I already assuming that they're gonna do what they has been already doing, that not doing what they said earlier they're gonna do. That's how they create the volatility. That's how they love to play with the markets. So we have really initial pull up toward heading to 158, and after that we had a pressure from Bank of Japan, government Ueda coming out and saying this thing. So the pressure was hawkish. He said we'll start reducing JGB purchases immediately after deciding at the July meeting. Okay. And he also said want to show guidance for JGB tapering for 1 to 2 years to increase visibility. And here comes the hawkish. July hike is naturally possible, depending on data. So he just opened the door of a hike by stating that July hike is naturally, there is a possibility over that. So that's what led to the sold of dollar and the baht, the USD yen, the yen eventually making no change at the price. Now again, because of the carry trade, the market is again heading to doing what it has been doing from the past years. They just start making this go higher highs. So again, this whole technical scenario is a different part of the video. We're not gonna go through the technicals right now. We're just gonna go through the fundamentals. The fundamentals stating that they did came dovish with not increasing their interest rate and stating that they are not conducting any kind of JGB purchases this meeting, or they're not tapering anything higher. In the presser, the Veda went hawkish and states July hike is naturally a possibility. So These were the two central banks we had last week, and keeping what banks said and how the data leads eventually creates a good trading opportunities for us as being a manual retail traders. And these are something we take as the benchmarks. Let's say the base for USD or for any nation's economy sits on the central bank decisions how they think, and the currency will go up or down depends on their approach over the data we have or over their interest rate projections. So if we look at the other data, let's go through some of the labor data. Labor data we had from Britain. So unemployment went up 4.4%, which is okay. So this is just going upwards, and it is high as November 2021. 4.4%, average earning 5.9%, and claimant count 50.4%. So this was the labor data came out from Britain, but as I said, I was not keen to trade this data because I was really focusing on the key events we were having from the US side. So on China, we had a CPI and PPI report came just as expected from the market expectations and showing not much, just 0.3%, staying there as it was last month, 0.3%. We also had GDP came as expected from British side. So core CPI we already discussed. Employment change coming from Australia 4.4%, sitting at 4%. Employment change just came better than expected. And we had lastly we had University of Michigan consumer sentiment coming a little bit worse than expected, but eventually it just got cancelled out with a reason we had upward 67.5 or got revised from 67.4 to 69.1. So preliminarily University of Michigan inflation expectations came 3.3%. It got revised from 3.5% to 3.3%, and eventually we haven't had any forecast, so it came 3.3%. So with that being said, that was the last week report, key events we had. Now, let's move to the next week. So this week, we are having three central bank decisions. We are having one CPI report, and we are having flash services and PMIs and manufacturing PMI reports from Euro side, Britain side, and from dollar from US side. So again, be prepared, guys. This is gonna be a busy and crazy week as we had last week. So and can create some sort of volatility over the markets because we are really having a three central bank decisions and one report. So it's really great to have these events because otherwise just get boring. There is not if there is nothing major going on across the across the week. So let's look at Sunday. Nothing major from New Zealand side. It's not something I'm looking to trade or something I'm thinking about. However, we do have China industrial production year of year and the retail sales coming out on 11 p.m. and the market currently expecting just a little bit downward from 6.7% to 6.2%, and the retail sales from 2.3% to 3%. So nothing major there. On Monday, again, we are not having much on Monday except Empire State Manufacturing Index from US side, and the currently it is down by negative 15.6%. Is market expecting some better data coming negative 12.5%. However, this data is really volatile because as you can see, sometimes market expected at negative 20 and it just came positive. Sometimes market expect positive and came as a negative. So this is really never comes as expected from the market point of view, and I really don't try to chase this data. However, the key event for Tuesday at 1:30 Atlantic Standard Time, we are having a cash rate from Aussie, and also we are having a rate statement. So as a reminder, the RBA last week surprisingly kept rates unchanged at 4.3% at the May meeting and retreated that the board remains resolute in the determination to return inflation to the target and is not ruling anything in or out, while it stated that returning inflation to the target within a reasonable time frame remains the board's highest priority. They also forecasted that RBA's forecast assumed that rates will stay at 4.3% until mid 2025. Recent mixed data releases also support the case to remain on hold as GDP for quarter one disappointed with the expansions 0.1% versus expected 0.2%. The monthly CPI report came on April was firmer than expected, sitting at 3.6%. Market was expecting 3.4%. We had previously at 3.5%. Unemployment employment rate, as we had seen on the last week's report, it's sitting at 4% from prior 4.1%. So the key events we will be looking at what the RBA has to say in their statement and in their presser about the inflation, about the projections, the about the labor market, and whether they're gonna cut interest rate or gonna hold. As I'm lo- as right now, the market is currently pricing in only one cut, which is getting expected by the stock markets. Only one cut for this year. However, it's just these are just the expectations. We do have to follow the central bank about their projections or their forecasts, where these projections are leaning toward. Now, moving to the core retail sales month on month. I mean, it's good, but not something looking to trade from the dollar side. We are also having a CPI report year from British. So really something that bank keep an eye on. And as we can see on from quarter one, it has really done well, reaching at 3.5%. On quarter two, it's just sitting at 2.2%. And if the inflation stays and goes down at the speed it is right now, then assuming market the bank will start cutting rates sooner than expected is not out of the ordinary. So, what are the expectations for this meeting? The market is expecting to hold the interest rate at the current levels with the let me just see with just worth of two cuts this year. But majority of the time, the first cut can be seen on September 19, 2024. But there are no cuts till then uh, from the expectation of our point of view from the store markets. Okay, so what next? We are having a GDP quarter of quarter point negative 0.1 to 0.1%. Okay, this is not something I'm looking to trade. Okay, so we are having also the 1 year and 5 year LPR. Mark expecting to stay right where actually it is right now. So, on Thursday we are having a two central bank decisions. First one is a Swiss National Bank from Switzerland and from Gabriel Pound monetary policy report coming out on 8 a.m. So first, go through the Swiss National Bank. In short, the main point of focus will be on whether they cut their further from the current 1.5% rate or elect to wait to see how inflation develops into quarter three. So pricing is just in favor of the SNB cutting at the June meeting, this meeting with around 60% chance. The odds of cut increase slightly following the inline May CPI year-to-year print of 1.4%, a metric with the matched market expectations for the month, and the SNB quarter two view of 1.4%. So the market is, as I said, currently pricing in 69% of possibility for a cut. So how many cuts are there for this year? Let me just have a quick look. So there are just only right now only one cut that is priced in for this year. However, market is still looking 34 basis point of worth cuts for the end of this year by December 12th, 2024. So the key thing to look in the presser, or in the statement is how, are they willing to intervene in the market by buying, by strengthening the Swiss franc to reduce the inflation in their economy, and how and some guidance on their foreign reserves. So if we look at the Great Britain Pound Monetary Policy Summary, or MPC official rate votes, so expectations are for the Bank of England to hold the base rate at its current level 5.25%. So the voters still says there we are having a two members 0, 2 and 7. So if you don't understand what 0 to 7 is, here is the explanation for that. The vote is voted in an XXX format. The first number is how many MPC voters to increase interest rates. The second one says how many voted to decrease, and the third one says how many voted to hold. So here is the 0, 2 by 7. 2 is Ramsden and Dhingra. 7 is the other MPC voters stating that they don't want to see any increase in the interest rate this season. So the prior meeting actually saw Ramsden joining Dhingra in calling for a 25 basis point of cuts. Headline inflation in April slipped to 2.3% from 3.2%. And the unemployment rate is at 4% or 4.4% currently. So as I said, it is always looking at what the central bank has to do about their forward guidance. So we will be looking at Bank of England presser meeting, that what they have to say about the current state of economy, where the inflation is heading to, and what their forward guidance is gonna be. 9:30 we are having unemployment claims. If it can be a market volatile, sometime it has been, but if it stays in a healthy territory, then I'm not willing to trade it. This one is. And on Friday, as I said, we are having a flash manufacturing and services PMIs reports from your side, from a Brent pound side, and from the dollar side. This is something we should keep an eye on. And if we look at the French flash manufacturing and services PMIs, just see these are sitting in a negative or in a contractionary territory. Manufacturing services is sitting at a not in expansionary or not in contractionary territory. So if we look at the pound, both are in a good expansionary territory. However, it depends on what we get on Friday. Just that being said, on USD flash manufacturing service side, we will also look what data came on before we start trading on these events. So, my friends, with all being said, it is very important to keep in mind that It is very easy to trade, but it is hard to make money from these trading markets. So it's a job, it's a full-time job. Don't take it as something that you can just jump in and think that you can make money out of nowhere and you're gonna get rich. But eventually, that's not the reality. So thank you so much for coming along at the end of this analysis report, and I hope you all of you have enjoyed it and got some insights. Maybe I try to help to give my thoughts on the markets, on the central bank rate decision thoughts. However, it is totally on you that how you want to take it. These are just my thoughts, and if you have any question uh, about macro events, just ping me on the comments below. And that is the end of today's session. And I'm just gonna save it and upload it on the YouTube. And see you next week with some more insights, with some more data on the table. Thank you very much.